Welcome to Factful Finance. Let me ask you a question. What if you could secure your financial future by simply understanding how to balance risk and reward? Sounds like a secret weapon, right? Today we're diving deep into portfolio diversification and risk management, two key pillars of a successful investment strategy. Did you know that nearly 50% of individual investors fail to effectively manage risk? It's one of the main reasons why so many portfolios underperform. But don't worry, by the end of this video, you'll understand how to shield your investments from the storm while still riding the waves of opportunity. First, let's start with the basics of portfolio diversification. Imagine you have a basket of eggs. Would you put all of them in one basket? Of course not, because if that basket falls, you're left with nothing. The same logic applies to your investments. Portfolio diversification means spreading your investments across different asset classes, stocks, bonds, real estate, commodities, so that if one sector underperforms, the others may still hold steady. But diversification alone doesn't guarantee safety. That's where risk management comes in. Effective risk management isn't about avoiding risks, it's about controlling them. For example, let's look at Noah, an investor like you. He diversified his portfolio across multiple sectors, but he didn't manage his risks. When the tech market tanked, his entire portfolio followed suit. Why? Because while Noah spread his investments, he didn't account for the correlation between certain asset classes. Here's where the magic happens. To truly protect your portfolio, you need to assess the risk-adjusted return, the ratio of potential reward versus the risk you're willing to take. It's not about picking the best performing assets, but about balancing those that give you the best return for the amount of risk you can tolerate. One effective tool is the Sharpe Ratio, which helps you evaluate if your portfolio's return is worth the risk you're taking. The higher the Sharpe Ratio, the better the risk-return trade-off. Let's say Olivia, a risk-averse investor, opts for a lower-risk bond portfolio with a Sharpe Ratio of 1.5. Meanwhile, Ava, a risk-seeking investor, goes for high-growth tech stocks with a Sharpe Ratio of 0.8. Olivia's portfolio is offering a better risk-return ratio, even though Ava's stocks might seem more exciting at first glance. This is why, when you're building a portfolio, you can't ignore asset correlation. Certain stocks and bonds move in tandem, meaning they could fall together in a downturn. On the flip side, when you combine assets with low correlation, you're better positioned to ride out market volatility. The next layer is strategic asset allocation, a dynamic process, not a one-time decision. As your life changes, so should your portfolio. For instance, if you're in your 30s, you might lean toward more growth-oriented assets. But by the time you hit your 50s or 60s, you may shift towards more conservative options to preserve your wealth. But don't just take my word for it. Let's bring this to life with a real-world example. Liam, a long-term investor, started with a 70% stock and 30% bond portfolio. As he got older, he gradually shifted to 50% stocks and 50% bonds to reduce risk. Despite market fluctuations, his portfolio's risk-adjusted return remained strong, thanks to his diversification strategy and proactive risk management. Remember, diversification doesn't eliminate risk, it just manages it. No investment strategy is foolproof, but a well-diversified, risk-managed portfolio stands the best chance at weathering the ups and downs of the market. So, how are you managing risk in your portfolio? Whether you're a beginner or an experienced investor, consider these principles to ensure you're on the right track. Want to learn more about how you can apply these strategies to your own finances? Drop a comment below. I'd love to hear your biggest money challenges. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. If this video helped you, you'll definitely want to see what's coming next. Click the video on screen.